Hi everyone, and welcome to the second review video where we'll be looking at topic 2, recording transactions. So the 5 learning objectives in this topic they are to overview the steps in the accounting cycle, to describe the purpose of an accounting information system, to analyze the effects of accounting transactions on the accounting equation, then moving on to understanding T accounts and debits and credits, as well as looking at the journal, ledger, and trial balance. Now, the first, I suppose, 2 of these are very much an overview of just the system that we're working within. So more higher level, more higher level aspects of what we're trying to do. As we move into the third, we're starting to understand how the mechanics begin to work. When we move into objectives 4 and 5, we're very much getting into the detail about how accounting transactions actually enter into a system and then move along the chain to become a financial statement. So when turning to the first objective, the accounting cycle, this is just a listing of the various things that need to get done. So we're moving from the economic event happening, taking those economic events, creating a journal entry, taking that journal entry, putting them into the T accounts, preparing a trial balance, the adjusting entries, the adjusted trial balance, and then from that we can actually prepare the financial statements. Once we've done that, we can't leave it at that point, and we end up with having to do a few things at the end of the year or the end of the period, with the closing entries, and then finally preparing a post-closing trial balance. Now this actually works a little bit easier to understand when we look at it in a more visual context, and it's also good to have a sense of what we're trying to do, and that really is to take an event which happens in any sort of business, any sort of organization. Things occur, and we're very much looking in this case at economic activity. So it could be products being made, it could be workers being paid, it could be services being provided, could be utilities being used up, a whole range of different things, but actual economic events taking place. What we want to do is to translate that into financial statements, because those financial statements can then be used by external stakeholders, for example, shareholders or potential shareholders, to get an understanding of what the business is about. Now, this is going to be an abstraction in a way. It's not going to be a perfect representation, but it is still a useful process, because people will actually take this information and do something with it. Now, to get to that point, the first step is the journal entry, and in that we debit account A a certain amount and we credit account B a certain amount. We'll talk to these in a little bit more detail in a few moments' time. The second step is we take that information from step 1, from the journal entry, and we post it to the relevant account. So if it's a debit to account A, we put it on the left-hand side of the T account. We then have all these various accounts that we're using, and we take them and we create a trial balance, which is just a listing of all the accounts that that particular organization has, with all the various debit and credit balances. Now at this point, this is what we'll cover in this particular topic. Now once you've got to the trial balance, you can actually create a set of financial statements. There may be some errors. Errors is not quite the right word. It may not meet the requirements of accrual accounting perfectly, but you can actually still create a set of financial statements from that. But to be more thorough, at the end of the year we'll have a number of adjusting entries, and this we'll cover in the third topic, and they will take the same form as what we saw in step 1. So debit account A, credit account B, a certain amount, and we can then create the financial statements from these. To wrap up the year, there are a number of things that need to get done. First of which is we have to close off a number of accounts with their closing entries, and again we'll talk about that in more detail next week. And finally, we have a trial balance with the post-close So we just basically adjust everything from those closing entries so that we end up with all the various accounts at their kind of completed end of year amounts. And then we're good to go again. And the cycle just keeps spinning. So, there is a need to have accountants because these things happen year on year on year. What's important with this is, even with all the discussion at the moment about machine learning and artificial intelligence and computers taking over the role of many of the functions of, say, accountants and auditors, there are still a number of decision points within this where human beings are very heavily involved. Now, the key points are really step 1 and step 4. So in step 1, the account that is being debited or credited and the amount is not always cut and dried. So there are some really important decisions that are being made at step 1. Similarly, at step 4, which we'll actually look at next week, the accounts are not always obvious what are to be used, and the amounts in question are often can be quite difficult to calculate. But in saying that, from step 1 to step 2 and step 2 to step 3, and then even to create the financial statements, these are fairly mechanical in nature. The reality is, back in the day, they used to get done manually, and that doesn't happen anymore. So we will be going through this, but it's not like you'll necessarily need to do this in practice, or many companies do these sort of things anymore. And that's because we have good accounting information systems which allow this to track all the way through. So if we look at, which I suppose in a nice way leads us to the second objective around the accounting information systems. So what an accounting information system is a system that identifies, records, summarizes, and communicates the various accounting transactions of an entity. Now, these are economic events which affect an entity's assets, liabilities, or equity at the time of an event. Now, not everything that happens within an entity is going to be an accounting transaction. Some things are. Paying wages to staff certainly will be. But just conversations amongst staff, potentially sometimes between staff and customers, these don't necessarily give rise to economic events. They may be quite important for the company, but they're not an accounting transaction. So not everything which happens is an accounting transaction. And there are a range of different accounting information systems out there, and certainly in the Australian context, you've got everything from Xero to QuickBooks to MYOB to Reckon One, and then you sort of moving into the larger systems as well. But if you're looking at small to medium enterprises, or even some medium to larger enterprises, you'll see these sort of systems commonly being used. This third objective is to look at the effect of accounting transactions on the accounting equation, which means we have to understand what the accounting equation is first. And it is simply assets equals liabilities plus equity. It looks really similar to the balance sheet, and it is. The assets of an entity are effectively what the entity is, well, at least from an accounting point of view. And on the right-hand side, it is basically who has a claim on the assets of the entity, whether it be the liabilities, so kind of external creditors, or equity holders. So I suppose they're not inside the company, but they are the owners of the business. Every single transaction, whenever it takes place, the accounting equation must always remain in balance. So that means you could have an asset going up and a liability going up, or it could be that you have an asset going up and another asset going down, or a liability going up and equity going down. However it takes place, the left-hand side and the right-hand side, they must always balance out. And when that transaction takes place, the role of the preparer is to determine which accounts will be affected. And as I was sort of mentioning at the top, that's not always obvious. It might not be obvious which account is affected, and it may not always be obvious how much the account is affected. But to remain in balance, at least two accounts will be affected. And that's this double entry nature of accounting, which was codified back around 1494 with Luca Pacioli. Now, the interesting thing about the double entry nature of accounting is it has been around, as I mentioned, for quite some time, but it has a number of features of it which are really important that we just have to get our heads around. The first of which is the T account, and if you look at the graphic there, I think you can pretty readily identify why it is called a T account. And these are just where everything is aggregated in relation to that particular account, whether it be cash or accounts receivable or loans or something else. The second thing that we need to have a look at is in relation to debits and credits. And these are commonly misunderstood, but all that debits and credits are is that a debit means the left and credit means the right. That's it. It doesn't necessarily mean increase or decrease. It just means left and right. So the left-hand side of an account is the debit side, the right-hand side is the credit side. Which then leads us to the question of which account actually gets debited and when, and which account gets credited and when. And the best way that I've come up with, and it's not just me, I mean this is a pretty common way to try to remember this, is to use the accounting equation. So an account increases, so this is whenever you see an account increase, you follow which side of the accounting equation it's on. So assets are on the left-hand side of the accounting equation and you increase them with a debit. Liabilities and equity increase with a credit, which is on the right-hand side because they are on the right-hand side of the accounting equation. This is the normal balance side because for any of those accounts, you would normally expect to see them having a balance on that particular side. So for example, cash, you will generally see have a balance of a debit. If there is cash in that particular organization or cash in that account, you would normally see it with a debit balance. With property, plant, and equipment, which is also an asset, you would generally see it with a debit balance as well. I can't imagine a situation where you would have a credit balance for property, plant, and equipment because you either have property, plant, and equipment or you don't. So it'd either be a non-zero number on the debit side or it'd just be zero. And the flip of that is that if these accounts increase with a debit and credit in the particular way that we see on the screen, they decrease with the opposite. So assets decrease with a credit and liabilities and equity decrease with a debit. Now this is, we could call it a cheat sheet, but I mean, it looks quite convoluted, but it's not really when we break it down. If we have a look at the middle column, or the middle column here, for the first three, assets, liabilities, and equity, we increase with the debit, increase with the credit, increase with the credit, which is just what we looked at, which means obviously the decreases are the opposite, and the normal balance is the same as the increases. So that's everything we've just done before. When we look at revenue, expenses, and dividends, we'll just focus on this middle column for a second. Revenues ultimately increase equity. So best way to think about it is they do the same thing as equity, so they operate the same way. So when a revenue occurs, you increase with a credit. Revenues and expenses do the opposite. Expenses decrease equity, so expenses are debited because it's the opposite. And dividends ultimately decrease equity because when they get paid, they come out of retained earnings, thus decreasing equity. So dividends do the same thing as expenses, so they get debited as well. Ultimately though, if you're going to be able to speak the accounting language, and it is a language, it is a syntax, you need to be able to just know what these are. And that often comes just down to practice and just doing questions and just working through this stuff. If you want to develop web pages, you need to learn how to write using HTML and CSS, for example. If you want to understand this, you're going to have to know your debits and credits. Once you get that underway, the rest of it is actually pretty straightforward. So now that we've covered off on debits and credits in the accounts, let's look at the steps in the equation, or the steps in the process. So the first step in the accounting cycle is to complete a journal entry for the accounting transaction, and this occurs in the journal. And a journal, just like if you're keeping a journal at home or a diary. Now, I don't do these things because I've tried, and frankly, I'm quite terrible at it. But if you think about them, that's just a sequential listing through time of things that have happened to you, or thoughts that you've had. That's what a journal is in an accounting sense. It is just a sequential listing of accounting events which have happened. To do this, we need to work out which accounting element, an asset, a liability, equity, revenue, expense, which one is affected and how much. And ultimately, we debit one account and we'll credit, well, we debit at least one account and we credit at least one account a certain amount. Whether it's an asset or liability, equity, or whatever it happens to be, that's part of that process of working it out. And we're going to look at an example in a little bit about how we do this. Once the journal entry has been written, we need to take all those journal entries and we need to put them into the ledger. And the reason why we do this is, as just a sequential listing, it's not that useful. You can't look at that list, and we'll see this in practice in a moment, and be able to work out what the balances are going to be, because there's just too much information, even with only a small set of transactions. So we take that information and we basically aggregate it into the relevant accounts. And that's quite a simple process. If it's a debit in the journal, we just put that amount on the debit side of the respective or the relevant T account. If it's a credit, we put it in the credit, and that's it. So it ends up looking something like this. Now, once we've done this, if you've only got a few accounts, you could potentially create the financial statements. But if you've got, tens of accounts, hundreds of accounts, thousands of accounts, that's going to be quite difficult. So once we've got all the accounts set up, we create a trial balance. And what this does is create a listing of all the accounts and their balances at a specific point in time. And it takes the form of an account with all the accounts listed down, those with a debit balance listed down, and then, those with the debit balance, the debit amount is put in the debit column, and those with the credit balance, the balance is put in the credit column. Once you've done that, you then have a nice, easily usable list to be able to create your financial statements from. And that's just what we're going to go off and do. Okay, so what we have here is a set of transactions which have happened over 1 month. And what we're going to do is to create the journal entry for each one, post the journal entry into the T account, and then from the T accounts, from the T accounts create the trial balance, from the trial balance create a set of financial statements. I'm not going to necessarily, well, for some of this I'll jump back and forward, so just sort of bear with me as we go through this. So when we look at the first one, after incorporating, Circle Films issues 3,000 ordinary shares to investors for $5 each. So in this case, we have assets going up and we have equity going up, and it's to the tune of $15,000. So transaction 1, debit, cash, credit, contributed capital, debit cash 15,000, credit contributed capital 15,000. Now, a couple of comments about this while we're looking at it. Firstly, always good to have some sort of identifier for the transaction. So whether it be 1, 2, 3, 4, whether it be A, B, C, D, however you want to do it, it's always good to do. I typically include the debit and the credit Just it makes it much more obvious what's being debited and what's being credited. You also indent slightly, and I put in just 2 spaces, the debit to the credit. Always put the debit first. When it comes to the amounts, use separate columns. So they're not running under each other, they're offset. So asset going up, equity going up. Circle Films purchases 2 HD digital video cameras for $9,000, so those are assets, and memory cards and USBs for $1,000, also assets. And we're assuming here that they paid cash. So debit, we'll call it property, plant and equipment, so PPE, camera, 9,000, debit, supplies, because those USBs and whatnot are going to be used up in the course of business, and credit cash, $10,000. Circle Films receives a $1,500 payment immediately after filming a customer's wedding. So they have received cash, debit cash, $1,500, and credit something $1,500, and because they have done the work, because they have performed a service, they are allowed to recognize revenue in that case. So debit, cash, credit, revenue. Circle Films receives a $2,000 deposit from a customer to film her parents' 50th wedding anniversary. Similar but different to 3, I should say. They received cash in both cases, but in this case they haven't actually performed the service. So we debit cash, 2,000, and we credit unearned revenue. Credit unearned revenue 2,000 to reflect this company or this entity owes $2,000 worth of work. 5, pays $250 cash to run an ad in the local paper, which will run immediately. So the ad we've paid for it, or the company's paid for it, and it's run straight away. So cash is going out, so we credit the asset $250, and we debit advertising expense $250. Films a dance competition, leaving a $3,500 invoice with the customer. So we performed the work but not received any cash. So we credit revenue because we have performed the service, or Circle Films, I should say, has performed the service. But they haven't received any money, so we can't debit cash, but they do have an asset, which is an accounts receivable. So they debit an asset, accounts receivable, to indicate that they are owed money in the future. Also, they're owed money now, and they will likely receive money in the future. Purchases another video camera for $9,000 by signing a 9-month promissory note requiring the payment of principal and interest at maturity. Interest is charged at 6% per annum. So debit PPE camera, $9,000. I'll come back to that actually. Credit note payable. Now, what's important here is that even though they are likely to pay more than $9,000, well, sorry, not likely, they will pay more than $9,000 in the future, at the point of the transaction is $9,000. They don't owe anything other than the $9,000 that they've effectively borrowed. Interest will likely accrue, or will accrue over time, and there will be adjusting entries that need to be made if there's a financial year end, but at the time that the camera is purchased, it is noted down for $9,000. 8, receives $3,500 from the customer in payment of the invoice relating to the dance competition. So we debit cash because cash is increasing, $3,500, and credit accounts receivable because that asset is reducing, and when you have an asset reducing, you credit the asset. And we'll look at these two together. These are two related transactions. This is performing the service and leaving the invoice, and this is collecting on the invoice. And what you'll notice here is at the time the service is performed, an asset is affected and a revenue account is affected. When the money is collected, an asset account is affected and an asset account is affected. When the money is collected, there is no revenue impact whatsoever. That occurs when the work is performed. And we can actually see that these two entries effectively cancel each other out. If we clear those contents just for a second, what we're ultimately left with is debit cash, credit revenue split amongst two different time periods or two different entries, and quite potentially two different time periods. And that's an important thing to note, is that the revenue is not driven by the cash collection. The cash and the revenue are separated. They may happen at the same transaction, but they may not. Nine, we pay wages, or they pay wages of $9,000 to their employees. So cash is going out of $2,000. And debit wages expense. And finally, distributes $1,500 in cash dividends to owners. So cash is going out. And in this instance, if you're not too sure what it is, the most logical thing seems to be dividends. Importantly, dividends are not an expense. They are a distribution of profit. So they're not called dividend expenses, they're just dividends. And they do not come out of profit and loss. They actually come out of retained earnings, so they don't affect what the net profit is. And while we're on the subject of how to name accounts, don't get too hung up on exactly what the name should be. The important thing is just to make sure that it is clear what type of account it is, whether it's an asset, liability, equity, revenue, expense. That's probably the key thing. Different companies will use different names. Even the same company over the sweep of time may actually start to change the exact name of a particular account. So don't get too hung up on the exact name that you use. Just make sure it's obvious what type of account it is. And that is doing the journal entries. If we zoom out a little bit, now if we were to take a look at this, 10 entries only, hard to see what the profit is, hard to understand, how many assets we've got in play. Just a bunch of stuff has happened. So to figure out, the journal entry, or to be able to work out the accounts, what we need to do is to set up the T accounts. So what we have here is the T accounts for the relevant accounts that we need for this particular example. So cash, accounts receivable, supplies, camera, revenue, notes payable, so on. And unfortunately, because of space issues, we've had to go below the fold. So wages, expense, contributed capital, dividends, retained earnings. And has a distinct T shape. And all that we do is to just work our way down the list and just put the amounts where we need to put them. So let's get started. So cash is debit 15,000, contributed capital is credit 15,000. Camera is debit 9,000. Supplies debit 1,000. Cash credit 10,000. Cash is debited 1,500. Credit revenue 1,500. Debit cash 2,000. Credit unearned revenue 2,000. Advertising expense 250, which is over here. Credit cash 250. We'll just pause there for a second. Now, a couple of things to note. I'm not having to do a huge amount of thinking. I'm just following wherever I've gone debit or credit and just gone debit, credit, and that's it. The second is I would highly recommend just working down the list as I'm doing here rather than just cherry picking everything from cash account and then everything from accounts receivable and PPE and so on. You're less likely to make mistakes this way. Debit accounts receivable, 3,500. And credit revenue, 3,500. Debit camera, 9,000. Credit note payable, 9,000. So debit camera, 9,000. Credit note payable, 9,000. Debit cash, 3,500. Credit accounts receivable, 3,500. Debit wages expense, 2,000. Credit cash, 2,000. So 2,000 debit to wages expense and credit cash, 2,000. And finally, debit dividends, 1,500. Credit cash, 1,500. Debit dividends, 1,500. Credit cash, 1,500. Now, once we put all the entries, what's left to do is to get the balances. For most cases here, it's pretty obvious what the balance will be. But the idea when calculating the balance is just to add up everything on the debit side, add up everything on the credit side, take the absolute difference, and whatever that difference is, you put it on the side where the balance is greatest. So in the cash case, well, I already know this, but it's the left-hand side, the debit side is larger than the credit side. And it's got a debit balance of 8,250. We can tell this is going to have a zero balance, quite obviously, and we'll just put it on the debit side because it's an asset. Supplies is 1,000. Camera is 18,000. Unearned revenue is 2,000 on the credit side. Note payable is 9,000 on the credit side. Revenue 5,000. Advertising debit 250. Wages expense debit 2,000. Contributed capital credit 15,000. Dividends debit 1,500, and retained earnings. I put this in here for completeness, even though we didn't see an entry on it. What am I doing? Credit 0. We've put all these together. Hopefully they will balance out, and we'll check that in just a moment, because now that we've done all the various T accounts, we can now create the trial balance. So we'll move over. And to create the trial balance, so this is the structure for the trial balance with all the accounts listed down, debit and credit columns, and we're adding up everything in the debit and credit column. And it's just a matter of working our way down and putting what needs to go, just taking the balances and putting them on the side they need to be on. So 8,000, if I can get it, 250, 0, 1,000, 18,000, 2,000, 9,000, 5,000, come down a bit, is 250, is 2,000. Contributed capital is 15,000 on the credit side. Dividends are 1,500 on the debit side. And retained earnings is 0. And what we have here is the debits and the credits all equaling out, which is good. It's what we want to have happen. And from this point, we can quite easily see all the information that we need to be able to create the financial statements, of which, let's go off and do that. And the first bit is we can take profit and loss. So So we'll move along a bit, and Circle Films. Fairly roughly formatted, but what we have is revenue of 5,000, expenses of 2,250, and net profit of 2,750. So it's important in this case, statement of financial position is as at, as opposed to for a period of time, and we will put in the various So current assets of 9,250. We have PPE camera of 18,000. So non-current assets of 18,000 for total assets of 27,250. If we look at liabilities, there's unearned revenue and notes payable. I'll do them. Unearned revenue should be current. Notes payable is, well, actually, they're both current in this case, given the timeframes that we're dealing with. So unearned revenue and notes payable. Current liabilities. Total liabilities. We've got 2,000, 9,000. So we've got 2,000, 9,000. For 11,000. And finally, we have equity, contributed capital, dividends, retained earnings. Contributed capital was 15,000. Retained earnings is the starting balance of 0 plus $2,750 in profit minus the dividends paid. So we turned up with retained earnings of 1,250 for total equity of 16,250 and total liabilities plus equity is 27,250, which is the same as total assets, so everything balances out. And I'll just make that a little bit smaller so we can see this. So we view. So statement of financial position, cash, accounts receivable, supplies for 9,250, PPE camera 18,000 for 27,250, 11,000 of liabilities, 16,250 of equity for 27,250. And what we've done is gone through steps 1, 2, and 3. We've gone through 1, 2, and 3, and actually then created the financial statement. So we've actually done step 5. And what we will look at in the next topic is steps 4, creating financial statements with some adjustments already made, and then closing things down for step 6 and step 7.